Hi, how's it going? Good evening. Welcome to the Stock Market Q and AMP, a session. An appointment that's already become a classic in the investor lineup. We usually do this on Thursdays, but we can also do it on Wednesdays. Keep in mind that we have to coordinate our schedules, and in this case, well, it's time for the Stock Market Q and AMP, seeing the portfolio at its peak, or almost, or maybe not. Right?
Yeah, you think it's funny.
You can see it on your face. See,
Like we were saying the other day in the research Discord, we've actually been doing this for 3 years now. In September, we hit the 3-year mark. So this is starting to have a bit of a track record and some history. And this year, looking at how we're doing now, we're beating the S&P by more than 20%. Last year, we also outperformed it by a good margin, and so on. We've had an annualized return of 26%, which isn't bad considering how little we turn over the portfolio. Everything is tightly managed in terms of risk and reward, nothing aggressive, with very little rotation, so it suits all kinds of investors. We don't have a very diverse subscriber base, for better or worse. Having different backgrounds, points of view, and so on enriches things, but it also means you have to be cautious in certain situations, right? I'm happy with everything. New highs, getting better and better.
very good, Miguel. Hey, I can see you're doing better because the infrastructure, Wall Street crazies, working out. You can tell with Miguel. Well, the best is yet to come. It's still not 100% set up. How are you, Miguel?
I'm great, really. First of all, congrats to you all for the portfolio. And to you because you've had quite an afternoon,
We're not.
giving you rest. People saying you're a real pro. Hey, congrats to you too, Antonio.
Yeah, we just finished 3 exciting days of options, a boot camp. Honestly, you all know I'm passionate about financial options, and the turnout was really great, almost 300 people each day. Fantastic. But let's stick to today's topic. You know we do a live weekly Q and AMP bay on Locos to Wall Street, and the Locos to Wall Street community is still growing a lot. Many of you are joining us, and you already know that Albert is the one who leads W Financier Research, which is our investor's guide, our premium service where we talk about investments, stocks, and so on. We also do this live session with a single purpose to chat about companies that you can ask us about through the chat to share how we see different businesses. Nothing we say should be taken as a buy recommendation, but we do give our opinion, as always, based on fundamentals. And while you're at it, you can start leaving your questions now. Let's see if we can meet the goal of answering as many as we did in the versatile 8 Q&A session, though I don't think we'll be able to beat that record. So Albert, beyond our current situation, let's start by talking a bit about how the markets are doing. We're seeing how companies most exposed to consumer spending are really struggling. There are companies of, I think, unquestionable quality, like VAL, for example, just to name one of the most notable ones. We see that despite being solid companies, they're very exposed to consumer spending, and as consumption keeps dropping, these companies are being affected. So, hey, first of all, while you all start leaving your questions in the chat and we get things rolling, Albert, I'd like to hear your thoughts on how you're seeing the current state of consumer spending. And let me take it a bit further. Could there be opportunities in some of these consumer companies that are being punished too harshly?
Well, look, for me, yes. As you said, right now, it's likely that we've already been in a recession, at least when it comes to consumers, not the markets, and in some indicators like the services sector and so on, but definitely in consumer spending. We may have already been in a recession in the United States, and maybe even globally, for over a year now.
This is reflected in sales volumes of major brands. As you mentioned, not just alcohol, which has its own issues, new generations aren't consuming as much alcohol. Even with defensive brands, we've seen it with Coca-Cola, Pepsi, McDonald's, and in some cases, general consumer goods.
So this is hurting them a lot, but in my view, it's a temporary issue. In other words, these aren't structural problems, but rather short-term ones. These are very stable companies that have historically been valued at demanding or relatively high multiples when they were growing, and now that they don't have growth for the time being, they're being punished excessively. And I have some examples here we can go through while questions come in people aren't familiar with and could be interesting. The first one I've brought is this one. Let me know if you can see the screen now.
Yes, while Alberta is sharing, he's going to tell us about a couple of consumer stocks that I think could be very interesting. Remember, as you know, we're showing the tool that we at Low Cost or Wall Street use to check fundamentals, ratios, and so on, which is Investing Pro. In the video description, you'll find a code and a link to subscribe with a 15% discount. It's a very comprehensive tool already equipped with AI, packed with data, and it can be really useful for you. So this is the tool we use. You can see how Albert navigates it, and now he's going to show you balance sheets, and so on. And just a reminder, in case any of you are watching this on a smart TV or something similar, if you don't have access to the link because you're not on a PC, I'm also sharing the QR code with you. Just scan it with your phone, and with the code LW, you'll get a 15% discount.
Great, Antonio. Right, we use Investin, and where we show. The first one I'm bringing you is General Mills. For those who might not recognize the name, it might not ring a bell, but they have strong consumer brands. Here in Spain, you probably know Old El Paso if you've ever made fajitas, Haagen-Dazs ice cream, Green Giant, and Cheerios. In the United States, Lucky Charms.
These are pretty strong brands, maybe not quite on the level of Pepsi or Nestlé, but they'd be just one step below. This is a company with a market cap of about 26 billion, and if we look at its fundamentals, specifically the revenue section, we can see that in 2022 there was a strong increase, and in 2023, even though volumes were down, they managed to pass on inflation and raise prices quite a bit, so revenues went up significantly.
If we look at the last 10 years, we can see that, well, it's not a great compounder, but it is quite stable. At least in terms of margins, it's not bad at all. In the end, gross margins for a consumer company of around 36 to 35% are actually pretty good. And then if we look at the cash flow, which I find interesting, we can see they generate about 3 billion in operating cash flow. They need around 500 or 600 million in capex depending on the year, so that leaves them with about 2.5 or 2.4 billion free. From this, they have to pay dividends of about 1.3 billion, which, considering their 26 billion market cap, is actually quite interesting.
That's a 5% dividend, a little more, and they still have 1.2 billion left over which they can use for buybacks, paying down debt, etc.
We see how they've been buying back shares aggressively, about 1 billion, as you can see. Of course, they're being punished now for not growing, but these buybacks at the bottom of the cycle and at low valuations are very interesting. These companies, if we ignore this past year, had performed quite well in the stock market. On top of that, as I mentioned, they pay generous dividends, and right now similar companies are also being punished, names you recognize, like Kraft Heinz, which is splitting. There's a special situation. It's separating into a sauces division and one focused on foods. So the merger they sold us years ago as bringing synergies, well, now they're undoing it, and this stock has dropped much more sharply. This was trading at 100 when Warren Buffett got in.
Damn.
I see the chart showing 60, but I remember it being more like 90. Anyway, it doesn't matter.
The drop has been brutal.
Yeah, it's at 25 now, so it's a company with better margins, especially operating margins. If you look at the gross margins, you can see they're pretty similar. In the end, Kraft's brands are generally higher quality than General Mills, but still.
But here's a question that honestly, I don't know. Which company is higher quality, the sauce one or the food one?
The sauce is likely better. It'll trade higher, but it'll be more interesting.
Both are together, but they'll separate them. They're doing a spin-off. So, shareholders will have both, but the more interesting one will be the sauces company, as we said. This generates about 4 billion in capex for dividends, 2000, and you have another 1000 left over, which you've been using to pay down debt and also to buy back some shares, etc. So, we've seen here that you have 3 billion left over in free cash flow, because even if you pay it out as dividends and you have a market cap of 30 billion, you're trading at 10 times free cash flow. True, it's not something trading at 2 or 3 times earnings, but these are very high quality, stable brands. These companies aren't growing, seem stagnant. The market punishes them for slow growth, but many are starting to look interesting.
Albert, look, you and I were just talking the other day. We had a conversation where I was asking you about Diageo. Right now, I think we can say that none of these companies are part of the model portfolio. Obviously, if any company is going to be included, out of respect for the subscribers who ultimately pay for the subscription, they will be the first to know. But it's true that some are already, let's say, on the radar. And I was asking you about Diageo because Diageo is a company that's always a classic among Spanish investors, if you'll allow me, because it's a stock that's very popular with dividend seekers, with buy and hold investors, and with value investors. And you even told me that there was another one you liked even more than Diageo.
Yes, now we're going to look at these two as well, which I think are going to be interesting. Diageo had performed perfectly up until 2022. We see that it was trading at 200 and now it's trading at 100, a 50% drop. It's a company that has nothing to do with the ones we just looked at. It's of a much, 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 much higher quality. We see that their gross margins are 60% and their operating margins are also incredible, plus their revenue growth history, if we look at the last 10 years, is much better than the stability we saw in the others. They have premium alcohol brands. I'm sure many of you have tried them. They're especially famous for spirits, which are strong liquors, just so we're clear. And I'll mention some of the brands that will definitely sound familiar to those of you who go out more or something like that.
So, for example, they have Guinness, which is a beer, but then in terms of spirits, they have Johnny Walker, Tanqueray, Baileys, Smirnoff, Don Julio, Casamigos, the best alcohol brands, and they're a global leader.
It's really interesting. I don't know, but let me go off topic, Albert.
No worries.
Global tequila consumption is growing at an incredible rate. I don't know, tequila is something that here in Spain, well, I'd say it's mostly just a shot you remember the next day with salt and lime after having it, but in the rest of the world it's growing. In fact, if you check out Diageo's investor relations, On their main slides, about 50% of the brands they highlight as their flagship right now is this tequila you mentioned, Don.
They managed to position working capital very well. Is inventory growing a lot here?
Yes, they've had a lot of problems. The inventory issue makes sense, and you'll see why in a moment, but they've had other problems too. The first one is related to debt. It's a company that has taken on quite a bit of debt in recent years. Let's look at it here in long-term debt, 20 billion, practically, though now it's a bit less. This is as of June, but they've made a couple of divestments. Still, in any case, it's quite high. And just so you can see what this compares to, let's look at their cash. This generates about 4.5 billion in operating cash flow, more or less, and they spend about 1.5.
They've gone through a capex cycle, but if you normalize it, it would be more like 1 billion. That leaves about 3.5. Then they have a very high dividend, taking away another 2, so there's not much room left to pay down debt. That's hurting them, and they'll need to speed things up once capex normalizes.
Did you notice? You can see it here, Antonio. We recruit the best. That eye for talent.
Miguel, only the top youth academy to the first team. The chosen ones,
Most of them stay.
on the way.
I'm already reading and tasting. What kind of transformation has Diageo had regarding alcohol? Although volumes are decreasing, there's a trend happening called premiumization. That is, people might not drink as much in terms of quantity, but when they do drink, they want to drink better. So, what does this mean? Well, it means much higher working capital cycles, because what they do, for example, is age the alcohols for much longer. So, what's the problem with that? Well, instead of leaving it in the barrel for 2 years, you leave it for 5 or even 10 years. So, for those 10 years, the investment you've made isn't giving you any returns yet. So you have money tied up that you've already paid, or your working capital is stuck in a bad cycle. It's the opposite of what insurance companies do with float. You've already paid, but you still haven't received anything. So this is a trend that hasn't been around for that long, and it's affecting them both in terms of working capital itself and also inventory. So this is hurting their cash generation, and on top of that, they've invested a lot to improve their facilities and so on. They've had a high capex cycle. For me, it's a company that was reasonably valued. The problem is they need to turn things around with their debt. As we said, they've piled up a lot. They're the most premium brand with incredible margins. If anyone has good prospects, it's them. But they need to get their house in order, and I doubt we'll see these valuations, at least not in the short term, that's for sure, because it was pretty clear here. People were pricing in growth after the pandemic, when big restaurants, home discos, and so on did a restocking. They had run out of inventory during the pandemic, and then they started buying more, which really distorted the company's numbers. Now, you're dealing with a worse part of the cycle where there's destocking going on, and they're basically getting rid of all the excess inventory that had built up.
Sorry, Miguel, go ahead, go ahead, go ahead.
Yeah, just seeing how things are a bit. Maybe I'm going to catch some flack here, right? But for me, when it comes to capital allocation, I don't really like it when they get to free cash flow and, even with debt, in other words, increasing debt, they keep paying out dividends like that. I would delay that dividend payout to pay down debt and give the US company a bit more strength. That's my point of view.
I would do the same. In the end, it doesn't make any sense to commit yourself etc. What happens is that the investor base of these companies I've shown you is very focused on dividends and the funds that hold them, etc. So canceling or reducing them, etc. leads to a big outflow, a bloodbath, and you face a lot of pressure not to do it. But from a capital allocation standpoint, it's just absurd to keep doing this.
It has a dividend yield of 5.2%. Sustainable investing.
Sustainable, yes, 100%. It's not optimal. If you start paying off debt now, they want to maintain a certain level of leverage because returns also come from the ROE, the return you get on your investment with debt, which works better. You don't necessarily need net cash or to pay off all debt, but you also shouldn't go to an extreme. They obviously trust in the quality of the brands, structural demand, and so on, but for me it's excessive, and on top of that, the interest expenses eat up too much of the cash flow, especially when you have to refinance part of this debt. So for me, it's excessive. I prefer others, and if you want, Antonio, we can get started after this. Question.
That's what I was going to say, because I'll pick it up from here. I asked you about Diageo, how you were seeing it, and you told me you liked another one better, which is the one you're showing us now.
Yes, this is Molson Coors. Alright, Molson Coors is a brewing company. So, the first thing about beer is that it has a better dynamic than spirits. In what sense? Well, beer consumption continues, it's growing, or at least it's not declining as quickly. Alright, so here you'll see a huge jump in revenue. That's because of an acquisition, okay, for which they took on a lot of debt. I wanted to show you this so you could understand where the balance sheet comes from as well. So this revenue chart looks a lot more like Kraft's or General Mills than Diageo's. It's not a company that has grown that much. They got a boost because they gained a lot of market share and sales at the end of 2022 and into 2023 with a campaign they did, if you remember, with a trans activist, the Gears AI Bush part. And as a result, they lost quite a bit of market share, which Molson Coors picked up. This is almost anecdotal. So, what's special about this company? Well, now you'll see that it has two things that I find pretty interesting. The first is that they either increased their debt a lot or have been paying it down, okay? After the acquisition, here you can see that this contrasts with the revenue we saw earlier. Obviously, it's not strictly linear, but we do see that there's been a significant deleveraging here. And the good thing is that it has operating leverage. Given the drop in volumes, in the end, with the margins they operate with, even if, for example, their business dropped by 10%, they wouldn't really suffer that much in terms of the cash they generate, right? Because if you translate that 10% drop in revenue through cash generation margin, the cash flow margin, the sensitivity isn't high and much can be offset with pricing. So even though the sector isn't booming, they won't suffer much. Why do I find it much cheaper and more interesting than Antonio? This generates 1.902 billion in operating cash flow and only needs to spend 600. So they're left with 14 to 1500 in cash to do whatever they want with it. What do they do with it? Well, it's very simple. The first thing is to pay a dividend, which in this case is 369 million.
Unlike the 1,300 Diageo, you still have 1,300 to do whatever you want.
The dividend is increasing significantly due to high margins. They buy back 5 to 8% of the company annually at these prices.
They are ramping up buybacks. After paying for buybacks and dividends, they still have 600 million and 400, that's a billion. They have 1,300. 300 million more can go directly to paying down debt.
So it's a company that has a good debt schedule. Maturities are only in 2026 and then not until 2032. So it doesn't have a debt problem. Even if it doesn't go up, it pays a dividend of about 4.3%, buys back 5 to 9% of shares, pays down debt, and trades at 8 times earnings. For me, it's a reasonably cheap and quite interesting company. Not only that, if they manage to turn the cycle around a bit or at least stabilize volumes, we could see some interest in performance, and we can see that it's really down. Down, not at COVID lows, but pretty much.
What beer brands do they have that we might know? Here, not so much.
You probably won't know them as well here, though they have some in Europe. For example, if you've been to the UK recently, they have one called Madrid, which is growing. In the United States, they have Coors Light and Miller Lite. Those are probably the most familiar. Miller Lite is probably the one you know best.
They have the Italian one, Peroni.
Peroni.
And they also have Carling in the UK, which is very well known.
Yes, well, very interesting, Albert. There are already some questions, but just a comment in case someone is watching and maybe not quite understanding everything. Notice that when you mentioned this company, Diageo, in this case you said it's higher quality than the previous ones. In the end, for you, what determines that? Because we always talk about what makes a company high quality.
There are many indicators. The first, obviously, is that there are many qualitative ones, like having a product that isn't easily replaceable or having what they call a defensive moat, etc. And how can you see that numerically? Well, probably with the ROI you have, and especially the ROIC, what kind of return you can get on the money you invest. And then in the margins, which is what I look at, both gross and operating, you can also see the quality of a company. In the end, if you're selling something for 100 that costs you 40, meaning you can put a markup of 60 on it, a very high gross margin, that means you have brand power. On the other hand, if your margin is 10%, you probably have much higher competition and have to compete more on price, and so on, right? It might not be a product of such high quality or added value that you can charge more for. The clearest example is luxury goods, with the margins they have, and so on. And in the case of Jaguar, it's pretty similar. Margins tell us a lot about a company.
Absolutely. All right, Miguel, let's get started with the selected questions.
Yes, Albert, here's a question that actually sounds familiar to me because I believe, Antonio, this is the company Edgar is analyzing. If I'm not mistaken.
This is the one that's going to be analyzed in the analysis course.
And
Modeling that just started.
I messed up. No. All right. What do you think about Turtle Beach, a technology company focused on audio for gamers? What caught my attention was the recent aggressive buyback of 20 million, and it's valued at 300,000.
Yeah, they're doing that. Edgar something interesting he put in.
Yeah, I only know what they do, but not much more. So I would say either ask her directly in the Sanhedrin queue, see what she tells us. And if not, obviously when we do the course, we'll share what we learn about her and bring her in. I don't know if you know more about it, Antonio.
No. Edgar finds it interesting, which is why he used it as an example in training, analyzing the balance sheet, profit and loss statement, etc., because it's a disruptive sector, but I don't really follow it from an investor's point of view.
When I saw it, Oscar was asking, "Hi, how do you see oil?" Thank you.
Well, that's a pretty general question, and we get it in every Q&A session. In general, I see it, Although there are some clouds on the horizon, the narrative that there's going to be a huge surplus, etc., not as pessimistically as the market does. That is, in the end, the narrative, as I said, is that there will be a huge surplus, oil everywhere, prices will crash to 50, and so on. And if we look, that's not happening, not in price hovering 70 or in fundamental indicators like refining margins. In the end, as you know, consumption isn't crude oil, but refined products, including gasoline, diesel, jet fuel, naphtha, etc. So higher margins indicate more resilient demand. Also, the futures curve, which was in backwardation, tells us there's a certain level of scarcity, as do other indicators like global inventories. So I think the consensus is overly pessimistic. We know that many times they end up revising demand data upward and supply data downward, and I think this time won't be any different. While it's true that we're not in a situation of great tension, demand is actually holding up much better than expected, and the same goes for supply, but in reverse. Not only that, but all the low prices we've had this year are going to end up translating into and resulting in a lower future supply or slower growth in supply. So, if someone believes in economic and human progress, which I think is a basic premise for investing in the stock market most of the time, then this is going to grow again, demand will pick up again, and things will improve. Even the IEA, which is known for being very pessimistic in its outlook and often delivering a message that's more political than scientific, has already said that where it previously saw the oil peak happening as early as 2026, now it doesn't expect it until at least 2030. So they're always pushing back these forecasts and these demand peaks to fit reality.
Albert Zucker asks if you think something will eventually take down Adobe. Before Albert answers, let me tell you, 2 weeks ago Edgar presented Adobe's results. I recommend you watch it, mainly because I didn't know much about the company either, and it's a company with extremely high margins that's now facing a lot of pressure because of AI. And Edgar especially highlighted the importance of the management team from his point of view. So if you want to check that out before I answer Albert's question.
Hey, and it's growing in subscriptions. I think it's an interesting company to look at.
I'm not a fan as you are, Antonio. If you want to share your opinion, I'll comment.
See, it's a company that's already growing in subscriptions. If you want, go ahead and start commenting, and I'll share a bit of it on the screen.
Great. Well, look, I actually think it's not necessarily a company that's going to disappear because of AI. AI has been overly pessimistic, just like what happened with Google. What is happening, though, is that the company's valuation was factoring in a much higher terminal value, which is now starting to be questioned, at least regarding future growth, which, as you know, is a key part of a company's value or how its valuation is determined. I think this will inevitably cause multiples to compress because it's no longer clear that the moat it had from that ecosystem of applications, the subscription model, as you mentioned, and how it can be leveraged, is sustainable over time. While it's not obsolete now, nor because of things like Banana or what Google presented, you don't stop using Adobe. It is true that, in my opinion, their competitive position has deteriorated with the advent of AI, and I don't think it will get any better.
Look, Albert, at the little things I'm showing on the screen, okay? Revenue is shooting up, 89% margin, gross profit, okay? Then the cash flow, well, we also see a share buyback, which is interesting. I don't know. To me, it seems like maybe, hey, you might be right. These are the typical issues when we, or you guys, hear us talk about an opportunity or a value trap, and it sounds like a flashy, very marketing phrase. But this is what investing is about. This is the whole point. For example, with teleperformance, people were saying, no, this is an opportunity. Well, it just keeps dropping. So that's when you find yourself with a company where you say, AI is going to end up disrupting it. I don't even know the word anymore. We need to learn how to conjugate the verb to disrupt, because we say it so often now. Well, with Adobe, something similar is happening. But right now you can't really tell. I don't know. Yeah,
But I think this is looking ahead. I mean, in the end, what you have to see is how they're going to sustain it in the future. It's true that it's been a fantastic business, and the valuation reflects that. The doubts I have, and it's not certainty, just doubt, are whether it will continue to be that way in the future, or if its terminal value is now more in question. So in that case, the multiples matter a lot, because of course, if I'm paying 5 times earnings, then it's not a big deal because I have a lot of margin for error if I make a mistake. But if I'm paying 40 times, then I'd better be sure that in 40 years, or that the growth rate is going to be sustained, that in 40 years this will still exist. And in Adobe's case, that's the doubt I have.
it's not exactly cheap either. It's at 21 times earnings. Well,
After dropping to
Tough.
sorry, Miguel.
I also think that with this kind of company, it's a bit like what happened with Meta in 2022, where in the end there's a lot of trust in the management team and we really don't know, like Edgar said, about the quality of the management team or if it's not as good as, for example, Zuckerberg's. It's true that with Zuckerberg, even though there were doubts, no one questioned the quality of his management team, or at least that's what I thought. We were a bit more doubtful about those temporary problems. But here, it's true that I don't know if we have a figure like Zuckerberg, someone so good at allocating capital, so good at adapting to new trends. I'm not sure here.
I don't really know. I don't have the CEO of Adobe in mind. Maybe some of our viewers can tell us. I'm sure some of them know. And I agree with you that Meta is a good example. But it's also true that there was a bit of consensus that, hey, as soon as Zuckerberg stops acting a bit crazy investing in the metaverse, things will get fixed. And that's exactly what happened. But anyway, if you have any comments about Adobe,
which I think was self-inflicted. I mean, that's what you were saying.
that's true.
But not here. Here it just comes at you unexpectedly.
Adobe topic interesting. Let's keep going. Miguel, there's a lot more.
You are.
Muted, Miguel.
He's muted. Vermilion started strong. The rise is slowing. Is there any near-term catalyst?
Not really a catalyst beyond earnings, drilling, and exploration results. Why has it gone up so much? Because insiders are buying a lot. So it's a combination of good performance in oil and gas. And as you know, the season in Canada has already started off cold. We're already getting storms and snow over there. And also, because the insiders are buying, there's speculation that it might be related to the exploration campaign they have in Germany, right? It's underway, and these are very promising wells that are showing very good initial results. And there might already be some information or developments, but it's not like there's been a major announcement or anything. Still, it's up about 15% just this week.
TF asks upon seeing this, what do you think about stablecoins and the Ethereum blockchain for the financial market revolution that Trump wants to carry out? If I remember correctly, he was really involved in that topic, with stablecoins and tying it to American debt, right?
Yeah, I find the stablecoin part interesting. And tokenization, as mentioned here, the origin of realm in terms of technology, in terms of the ability to provide liquidity, and so on. And it also represents a revolution compared to what was proposed with central bank digital currencies, where in the United States it was already voted not to implement them. Here in Europe, it looks like we're still going to have the digital euro. I think the path is they're trying to bring to the market something that already exists and is better, like stablecoins, and that's why it's not going to succeed. As for Ethereum, right now, technologically, it's no longer the best. It's true that it has the most adoption, but there are other much more interesting options, even Solana. And I'm unable to judge whether Ethereum will be the one in the future or not. The only thing I'm a maxi about is Bitcoin, and as for the rest, I like the technology, but that's all it is, just technology. So they don't have a moat like Bitcoin does.
Antonia, have you heard about the stablecoin topic? Have you?
Yes, I've heard about it, but to be honest, that's an area where I just go with the flow. When it comes to all those topics like mining and so on, it was actually just last year when. Last year, honestly, in the Rizar, Albert and some other users had a couple of good ideas that worked out pretty well for me with OP. I remember with Core, with the Bitcoin ETF and all that, I just went along with it. I just do whatever Albert says there.
Pedro Perez, good evening. Just to keep up the tradition, any comments on a good, quality, and defensive company? I saw that they have an interim CEO. Do you know when they'll appoint a permanent one?
Well, about the permanent CEO, the previous one left, and as you said, they've put someone in temporarily. I think his name is Rogue Oil. That's the last name exactly, but he's not exactly Spanish. Well, he's Latino, and he was already an employee, so it's not like.
And what I wanted to tell you about GN is that, let's take a look at it too, if you want. Rake, I'll project it. In WEN, something curious happens. It's a company that, unlike others, grows, both in pure revenue, which could be due to price, and in volumes. In fact, we have a report about to be released in the research section on the restaurant industry that I think you'll find quite interesting, because we talk about which metrics are important to understand this business, who the main companies are, practical cases, and so on. So, well, it's a company that does show financial progress by any metric you look at: growth, number of restaurants, same-store sales, price increases, and so on. It's actually quite cheap, but what the market doesn't like as much is that the brand isn't as premium as others. Obviously, Wendy's isn't the same as McDonald's, and then there's the large amount of debt they have, even though it's intentional, okay? Due to expansion and efforts to improve profitability, their long-term debt stands at $2.6 billion. If we look at cash flow generated year, operating cash flow about 350 million. They have debt. If we look at normalized CapEx, it be 80, leaving us with 270.
They've cut the dividend. Last year it was 200 million, but this year it's less. They haven't cut it because they can't afford, but because they're buying back shares aggressively. They've ramped up buybacks this year, which is creating a lot of value. It's not trading at a high price, it's trading at 9 times earnings.
Actually, in terms of free cash flow, it's even less. Then the concerns the market has are obviously the consumer recession we mentioned earlier, and especially the debt they have.
Albert was saying that they're not going to pay the long-term debt that's coming due Or as he says,
They're going to keep refinancing it. They pay off part of it, but the idea isn't to pay it off.
Oh.
We saw this with Lowe's as well, the competitor to Home Depot like Leroy Merlin. They also increased their debt for buybacks to improve their ROI and leverage.
Val Jesus Pinazzo, any comments on the short rep by AGOEC, the Canadian subprime lending company?
This is an interesting topic. For those of you who are part of financial research, if you want, you can ask Mr. Kamikaze, who I know also has it on his radar.
Yeah, in fact, he's been talking about it today. Look at that.
I didn't see it.
Yeah, well, he's been talking about it on Discord, so he knows it really, really well. I haven't looked into it in detail, to be honest. It's a business that doesn't really appeal to me from the start, so I've never looked at it, and obviously it's done really well. So maybe that's an omission error on my part, but I've just never looked at it. He does know it, and he's been talking about it.
Jesus, on Friday, like in your town, I already sent it to you.
Earlier in the chat. Tuco asks, how do you see Brown-Forman?
It's the same as Diageo, but worse. Brown-Forman dropped sharply. It's the same thing. There was at 70, now at 27, and it's 15 times PE, so it's still more expensive. Why? Because it really only has one good product. They keep launching new products, but the real appeal is Jack Daniel's. Not a great brand, but for the rest of their brands and market positioning, it's much worse. Also, its main market is the US, and it's a company of lower quality. We can even see this in their revenue, a more pronounced decline, worse margins as well, and don't think it's all that financially healthy compared to Diageo. We see that it has $2.4 billion in debt, and in terms of operating cash flow, it generates $600 million. But if you subtract this, you're left with about $400 million. Yes, it has less debt, but not dramatically, and its brands are much worse. Jack Daniel's is better than Diageo brands, but there's no comparison.
Trader asks us, that has been dropping for a few days. What do you think? Dead?
Yes, you already know this is one we've historically held in the portfolio, model, etc. I love it, but the return we were expecting was already lower, and that's actually why we got rid of it. We don't hold it anymore, so that's why I can talk about it. And it's also being affected by the big run-up it's had. In the end, you have to put it in context and see where it's coming from. We see that, yes, okay, the highs were 60 and now it's in the low 50s at 52. But a year ago it was half that. It even dropped to the low 30s.
Let's put this in context. News about Altria's joint ventures also affects it, as that's its competition.
So it's fine, a very solid company, allocating capital well, paying down debt, doing buybacks with a spectacular dividend, and it's way ahead in returns, launching new products, making those new products profitable. But at the current price, the return I was getting no longer seemed as interesting to me.
Alvarez, if I'm not mistaken, is asking us about. In fact, it's the cover of our live stream, which is about Bill Ackman. What do you think about Chipotle? What's our opinion? Actually, its stock price has dropped too, right?
Yes, this has dropped quite a bit. I didn't follow it, except for things like Wingstop, because of Ackman's involvement. But in the restaurant report, you'll find the info explaining why this is happening, which metric is deteriorating, and why it's not interesting.
In the end, what the market values is also the growth in terms of store openings, etc., and that's what has slowed down. So I don't know it as well, let's say, as the case of Wendy's, but I encourage you to read the report where we have a specific case study on Chipotle.
I understand that when looking at this type of company, in life or the number of openings, I understand that it has a big influence when it comes to valuing it.
Yes, the key points that the analyst who helps us with this, Alpates, actually gives us are the openings of new restaurants, like you said, the same store sales. And then there are also things like margins, etc., but those are crucial in the restaurant sector, and in this case, things are slowing down a lot.
Sergio Santos, STZ has dropped a lot, and next year they're cutting back on the expansion of the new factory in Mexico. Pros: World Cup Soccer USA 2026. Big brands versus Hispanic consumption, which is 50% threatened by regulation. Sorry, what I meant is
Trump's thing.
about Trump.
Yes, Constellation has better brands than Molson Coors, like Corona, but it's more expensive, as you said, plus it has a large Hispanic customer base. Well, that's neither good nor bad, but obviously when you depend on a very specific demographic segment, and that segment is currently being targeted, and it's also one of the ones suffering the most right now in terms of consumer crisis, disposable income, and so on, then things aren't going so well
For you. They are better brands, but they're costlier than Molson Coors, so I like them less. They are higher quality.
Upon seeing Night 7, what do you think of AMD? To me, it seems like a clear example of short-termism without relying on the major advancements of AMD's GPU versus NVIDIA.
Don't answer him. He's already made what he needed to make this year. Today, he showed me the profitability of his portfolio. I'm going to.
Shut up. Antonio was carrying it.
I'm going to shut up, keep quiet.
Me.
I'm going to keep quiet. He knows it.
Well, first of all, congratulations, of course, and you also have a long track record tied to research. So, well, yes, exactly. I'm really glad things are going well. In AMD's case, if all the reports I keep reading are about cutting tech capex, they always seem expensive to me, but of course, the performance is there. So you probably know 100 times more than I do, I think, about this, about AMD.
Alright, here are 3 questions that are basically very similar. I'll mention this one at the end, but there are 3 similar ones asking for some comments on Dynacor with the rise in gold prices, which, interestingly, the stock price isn't showing much correlation, even though it benefits from the increased revenue. And basically, both Alberto, Dante, and Ops are asking about this.
Perfect.
Well, in Dynacor's case, what's holding it back right now is the lack of news. It's actually a company that used to report its revenues month by month, if you remember, and that allowed for more real-time tracking.
And since the middle of this year, since June, they said they were going to do it quarterly. We'll get the report soon, likely early October, as it's operational, not financial. The financial report takes longer after the quarter. I think they're executing well, but the lack of news, extra investment in capex and personnel before revenues is impacting margins. An industrial small cap in Canada attracts very little investor interest. So everything comes together for it to be so depressed, but there's nothing fundamental in terms of news that explains why it should remain as weak as we're seeing now.
Another question about consumer goods. Speaking of consumer goods, in the LE.
It's very good, even higher quality.
We can also see this, if you want, reflected in the case of Nestlé. The thing is, given its valuation and growth, I think this will yield you, at most, between 10 and 12%.
Also, for those who are heavily affected by currency performance, that's why their results always take a bigger hit. Since they report in Swiss francs, they may show revenue growth, but when reporting, you can face headwinds. It might turn out that capital allocation isn't ideal. For those of us living in Spain, the withholding tax on dividends also makes it less attractive, and you end up expecting less. Still, I do believe it will see growth of around 3, 4, maybe 5% in revenue, plus the share buybacks they're doing, which add another 2 or 3% per year. So you'll get a return of around 10%, maybe a bit more. You're buying a lot of quality, but it's true that the growth margin is smaller compared to other consumer companies as well.
Carlos Bonfiglio, what do you think about green? The company continues to execute well. It's just had a couple of quiet quarters in a defensive sector, and the market has punished it a lot. It's trading at only 5 times EBITDA, if I remember correctly. It's the Swedish garden maintenance company, right?
This must be the one, right? If you know it, Miguel, you answer, because I don't even know which one green that is.
Carlos, honestly, I don't really have a formed opinion about the company. I know what they do, which is basically maintaining Swedish gardens, and these are companies that, it's true, are quite defensive and usually don't trade at very high multiples. But it's also true that since they don't have any visible catalysts, the market maybe doesn't love them much. But like I said, I can't give you an opinion because I don't have one. To be honest, I haven't followed it, but I do know what they do.
Do you know it, Antonio?
No, it came up in one of the editions of the analysis and modeling course. They analyzed it and all that. But like Miguel, I just know what it does and that it was listed in Sweden. No, it's not on my radar.
Alex Trepat Long and the whole quantum thing.
The whole quantum thing, to me, is a huge bubble. There's still a long way from being able to generate any kind of return, and we can look at some examples, etc., but I wouldn't short it or even touch it. This is a company, look here at the revenue it has, it's one of the most well-known, 10 million, and we have to see where that comes from and how much it's worth. Let's see if we can find that here. Look, it's valued at 10 billion. No, well, obviously this is a massive bubble that's running purely on narrative. We're basically back in 2021 again, but it's working. If someone went long on this, they've definitely done great. This was at $1 3 years ago, and now it's at 30. Even just a year ago it was at 1, and now it's at 30. Going short or betting against this is crazy. With Carvana, for example, if you ask me, Rigetti will exist in 10 years, probably not.
PT, study oil and gas sector, E and F wink with tongue sticking out. Advised to get started?
Well, look, in our course on investing in commodities and energy, Danny Castrolijo has put together an oil module with about 40-something videos. And then Albert will give the final lecture explaining how to use the Resistor monitors. So we can't really be objective here. PTT.
Outside of the courses which teach the technical side, exploration, production, analysis, also read the book on capital returns to understand the industry from a macro perspective. That will help you see how to approach these investments.
Jose Alexander Sanchez, Greetings, guys. What do you think about lithium? Today it shot up, lag, when you could see SQM. Regards.
Jose Alexander is a subscriber. We'll cover lithium topics in the subscription. The price rally wasn't justified due to a temporary supply issue in China, the exit of about 3% of global supply. It's still too soon from a supply and demand perspective. In this case, since it was due to government investment, considered strategic, and so on, the rally is different. But I still think it's too early for this to have a fundamental rally. As we're used to, the best time to buy is when the cycle is at bottom, and right now, it is. I think there's still a bit to go before it starts to recover.
Before we continue answering questions, Miguel, just a reminder, you already know that with the Investing Pro LW code, the link we have in the description, and this QR code, you get 15% off if you want to subscribe to the tool that we consider very, very useful. And another thing, if you agree, there are still about 10 questions left to answer, so we don't drag this out too long, and so on. We'll finish answering these, and for any that are left, you can ask them either in the YouTube comments, on Discord if you're part of Resa Premium, and so on. Or if not, next week when we have another Q and AMP, a session. So let's finish answering the ones we have. And please, if anyone has anything else or any other questions, we'll handle them through those channels, okay?
Kroru, you've talked about petrochemical companies. Can you talk about Dobai, Braskem? Thanks.
This is also a classic topic that we keep updating week after week, right? But it's normal for you to be interested in these companies. I want to.
Nothing has changed. It's the same. This industry is at the bottom of its cycle and will likely recover by late next year, 2027. We'll see real progress, especially as China's overcapacity phases out. In the case of DOU, while you wait, one of the highest quality companies. For Bras, other problems and opportunities, specific issues related to the balance sheet, the Halagoas problem. So you're not just playing a petrochemical cycle like in Dow, which I think is at the bottom right now. If you get in now and have patience, you'll end up with more quality. But for Braskem, there are other considerations. It's also likely you have optionality with tender offers, news about acquisitions, especially now negotiations continue with Santanura even after exclusivity ended. But you run a much higher risk of permanent capital loss than with DAW.
Benzaimoto says, time to take another look at HelloFresh. Any fundamental explanation for the drop?
No, but it is true that the market wasn't expecting such a big drop in revenue, especially in the ready-to-eat segment, which had been growing at a very high double-digit rate. We've now seen how that came to a halt and stopped growing. Also, the reduction in marketing has improved profitability, which is what they promised, and I think they're worth more now. It was at 7 and change the last time I checked, and for me, it should definitely be worth between 10 and 12. The market needs to see execution, and that the slowdown in ready-to-eat doesn't turn into a decline like with meal kits. So, for now, they're skeptical. On a positive note, the CEO has started buying again. For me, that's a strong sign of confidence. But anyway.
Today, if I remember correctly, an analyst once again set a price target of 14 euros per share.
Yeah, I think I saw that too. I think that's how it was.
Let's keep going. Alejandro, do you think GR Gold is better than Harmony Gold? Money? Well, to see if you wanted to continue talking about Hello Friend.
No. And since I don't know, I can't give opinion. I don't know if you know them, Alexander.
Say that for Sunday. On Sunday, we have a program where, well, I'll tell you in advance at the Sanhedrin. This gentleman here, not me, Miguel, is going to talk to us about Basic Fit, which is a company I'm sure you all know, right? And I'll tell you now, an investor is coming to talk to us about gold soon. Did you know that?
Yes. Plus, it'll be useful for you because there are a ton of questions about gold here. Brunette, opinion on metal company. You all do a great job. Best regards. Thank you very much. Brunette.
I don't know it either.
All right, this one's from David. The AZ Valor Fund is a bit stuck right now. Do you think the macro situation positions it as a good candidate to improve its future returns?
Yes.
I don't know the exact portfolio AZ must have, but I imagine themes, and they'll do best in this period. Yes, the economy is accelerating and inflation is slowing. I sense they are positioned. I last saw them a little more than a quarter ago.
I think they are very well positioned to do well. I don't know how things are going this year either, but hey, they're very good people. They may have better times, worse times, but they know what they're doing.
That's Perez. I am taking advantage of the liquidity to expand Glencore and HCC. I understand that it will be a bit of a comment on both.
Bye, Antonio.
No, I didn't point out the next question Tomas asked, how we saw it at these prices.
All right, with Glencore, you have a catalyst today with Freeport's copper problems, which made it go up. Also, coal exposure, which is why you relate it to Warrior. For Warrior, coal fundamentals don't justify current prices. The whole sector is rising, but the market is always forward-looking. For Glencore, I see the value more clearly. Tila.
Fabian Alvarez, Alibaba, who in fact we also recently brought Sanger, Gabriel CA. I mean,
Gabriel, our friend Gabriel. Hey, by the way, congratulations are in order. What an amazing year he's having, really making a mark.
absolutely.
And he really saw this trend in China from the very beginning, so congratulations to him. Today, they mentioned accelerating investment in AI, which has driven it up. You all know I don't invest in China. Geopolitical risk outweighs potential reward, even with many cheap things. But it's definitely working wonders. Alibaba is very interesting for several reasons. It offers exposure to all current macro trends. It's buying back shares. It's cheap. It's growing again in e-commerce. If capital flows into China, it's going to flow into Alibaba, as it's the poster child, the most followed company there. So it's very interesting if you like to play with this idea.
Just to share with you, Fabian, and actually Edgar often reminds us of this. The thing is that, in the end, Gabriel Castro gave me the impression that he had been to China many times, that he knew Chinese culture very well, that he was really immersed in the Chinese culture. In fact, a lot of the explanations he gave us were about the results, but above all, well, Antonio might remember, he would tell us how Chinese society works. And in the end, the three of us are so far from there that sometimes investing in places that distant, and companies like those, if you're not close, is complicated. I mean, I think the more you know that society, the closer you are, the easier it's going to be for you, or for that.
What is an irrefutable fact is that almost everyone who goes there comes back convinced.
About Alibaba.
About China, almost all the investors who go there come back convinced. So I'm the same. I don't have any investments in China. Alibaba. I have some calls, I admit it. Val, but I don't have any. No, 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 not at all. I have a leap on Alibaba and it's going really well.
Albert, we're going to have to send you.
As a correspondent.
And the last one, Renato Porto Carrero Antonio. Just out of curiosity, did you follow up on the open topic you mentioned to me in the last Sanhedrin? Yes.
I'm following it. I'm following the open topic. If you remember, it was at 9 and something, and it was going through some turbulence. It's a topic worth analyzing. I'm not going to take a position because I think it was way overheated. If I had to take a position, I would take a short position. I'm not really into short positions per se because that's not my investment style. But I'm definitely interested because they've hired a SEAL who comes from Shopify. I follow him on Twitter. I usually make myself a kind of list of things there. For example, if I want to learn about uranium, I have a uranium list. Now I have an open list with investors who talk about open, and from time to time I check it on Twitter. The CEO is also very active on Twitter. Eric Jackson has been on Twitter for a long time. The company is going down, and well, he has some revolutionary plans, honestly. The thing is, on paper, everything looks great. There are also critics. And the other day, a user gave an example where he said, yeah, sure, but look at this house. Open bought it for $590,000, renovated it, put it up for sale at $600,000. And in the end, look at the price. They had to lower it and ended up selling it for $500,000. In other words, Open is also exposed to the real estate cycle in the US. It's not so clear-cut. The pro-open crowd talks a lot as if the drop in interest rates in the United States is going to be a cure-all for the housing and mortgage market. In principle, yes, but we also have to see how all of the issues we're seeing with job insecurity, which the United States is experiencing on that front, will affect things. But of course, this is like someone who loves soccer and says, I'm going to watch a derby, a Betis versus Sevilla match, without really having any allegiance or feeling the pain because it's not one of your teams, and you just enjoy it from the sidelines. I have no stake in it, but I think it's a very interesting investment topic to keep an eye on.
Yeah, it's super interesting. I followed it, Antonio, in the last few days because on Discord, in fact, if there are still questions, you can also send them through Discord. People were asking a lot about the company. Honestly, I didn't know about it before. Yeah. And I found it really interesting that the new CEO basically didn't have a cash salary. He pretty much didn't have any. It was all in shares.
Hey,
Quite a lot.
of shares.
There was a 30% short position. No, Antonio.
The company has a 30% short position, which they present as a huge short position. The thing is, when you're used to a 100% free float and more, everything else seems small. But yes, it's a significant short position. But like I said, I prefer to watch from the sidelines. It's true that I'm keeping an eye on the options. That's for sure. I'm watching them, but I still haven't opened a position. If I did open one, I would let you know.
Same here. I'd rather sleep easy for now.
For now. Yes. Very good. Well, guys, this is Q&A session number 9. We're going to be really close to last week's session. Honestly, it's been really dynamic. Albert might have a few negative traits. Very few. He's a genius, as you can see, a privileged mind. But one thing's for sure, the guy doesn't ramble. He fires off questions, sums them up for us. And I think that brings a lot of energy and is the reason why, on a Wednesday at 10:35 at night, there are 637 people across all platforms. So thank you so much to those 637 people. Thanks for the likes. Thanks for subscribing. And you already know, you can find us in the Locos the Wall Street financial research community, where Albert is, where Edgar is, where we are with reports, and so on. We'll see you Sunday at the Sanhedrin. A big hug to everyone. Bye. See you next time. Thank you.